Welcome to StaalX Construction and Steel Podcast. Episode 5, Data Center Construction is Raging, Office Construction may be next. Before we start, a quick shout out to StaalX, the smarter way to source steel. Whether you're buying rebar, wire rods, or mesh, you can now get instant pricing, make an offer directly online, and track your orders, all in one place. Check out our new walkthrough video, How to Use StaalX, and see how easy it is to get started at StaalX.com.
Welcome to the deep dive. Today we're trying to make sense of how these big shifts in construction, these macro trends, are actually hitting the ground in specific commodity markets, specifically steel.
Right, and we've got these two really different narratives you sent over. It's fascinating. You've got some, surprisingly positive signs from the commercial office sector on one hand.
Yeah, a sector everyone sort of wrote off.
Exactly. And then on the other hand, this just massive expansion in very specialized construction. It's quite the contrast.
It really is. So today we're digging into the latest construction data, looking at how it directly influences the steel market. We've got a recent office market report and the StaalX steel market update to guide us.
And the main tension seems to be, okay, there are signs of life in offices, but then there's this huge force of data center construction. How does that clash play out in things like rebar and wire rod?
That's the plan. We'll look at the office market first, then the data center boom, and finally how it's all shaking out for steel. Okay, so let's start with that surprising bit, the good news from the Q3 2025 U.S. Office Market Dynamics report. You look at these numbers, and it suggests demand has been stabilizing for, 2 years now?
That's right. And the big headline number, the one that really jumps out, is the first decline in overall vacancy since way back in early 2019.
Wow, since 2019. That does feel like a turning point.
It's a significant shift, and you can measure the stabilization. Gross leasing volume, it grew, 6.5% quarter over quarter?
Yeah, QOQ, reaching 52.4 million square feet.
Which is huge. That's nearly a post-pandemic record volume, just like 400,000 square feet short of setting a new one.
And it's not just, one or two hot markets carrying the load. The report says 18 markets are actually exceeding their pre-pandemic leasing activity.
18, yeah. And another 7 are back over 90% of those levels, so it's broadening out.
And the return to office thing seems real, too. Office attendance hit a new post-pandemic high in July.
Yep, 80% of pre-pandemic levels. That's important because it means actual use of the space.
Right, and they tied that partly to recent mandates.
They did. The Q3 mandates affected maybe 250,000 workers. Doesn't sound like a ton on its own, but it suggests, a follow-on effect. Other companies might be seeing that and deciding it's time.
So real physical demand returning to existing buildings.
Exactly.
Okay, so the demand side is showing signs of life, maybe slow healing. But here's the kicker, right? And why it matters for construction materials. The supply side is just seized up completely.
Yeah, this is where it gets really interesting. So tenants are looking for space, especially the good stuff, the high quality spaces, but the development pipeline collapse.
Collapse how badly?
Think about it like this. Back in 2019, there was over 50 million square feet of new office space in the construction pipeline, planned, scheduled.
Okay, and today?
Today, less than 6 million square feet.
Wait, 50 million down to less than 6? That's an almost 90% drop? That's staggering.
It really is. And the active pipeline fell another 20% just in Q3.
Wow.
So major markets are averaging less than 500,000 square feet under construction. Peanuts, really.
Yeah, the consequence of that, if no new supply is coming.
Right. Even though overall vacancy is still kind of high, the good buildings, the modern Class A stuff built since 2000, that space is getting tight. Vacancy there actually dropped over a full percentage point, 104 basis points in the last year. It's tightening up much faster than the rest of the market.
So if you own a nice modern building, things are looking up. But if you're a construction company focused on building new offices,
you're looking at basically nothing major on the horizon. The demand for materials, for steel, from traditional office construction, it's negligible right now.
Okay, let's pivot then. If the office pipeline is dry, where is all the construction demand coming from? Because like you said, the steel market isn't exactly relaxed. What's driving non-residential construction so hard that steel, especially long products, is still tight?
Yeah. That's the core question in these sources, isn't it? And the answer seems to be pretty singular right now. Data centers.
There's data centers.
Pretty much. The amount of money pouring into AI infrastructure, building these facilities, It's just unprecedented.
The StaalX steel market update really frames it that way, doesn't it? It calls data center construction the main engine.
It does. It basically says this segment is driving the vast majority of private non-residential building right now, and essentially keeping demand for long steel products afloat almost single-handedly.
Wow.
But
And this is a big but. This is where the optimism kind of hits a wall. The StaalX report flags this reliance on just one very hot sector as, their words, too close for comfort. Too close for comfort.
yeah,
Why? What's the specific worry? Is it just the concentration risk, or is there more to it? Like this talk of a speculative bubble.
it's both, really. You have to look outside the immediate AI buzz. The wider construction outlook for 2026, it's actually looking pretty pessimistic precisely because of this reliance.
Okay.
Take the Associated Builders and Contractors, the ABC report. It's a key industry measure. Their data shows that backlogs for general contractors outside the data center boom have fallen by a third.
A third, that's huge. So that suggests pretty widespread weakness in almost every other type of non-residential
Yeah.
building. Retail, industrial, hotels.
That's exactly the implication. The big concern is that all this capital is flooding into AI infrastructure now, driven by promises of massive quick returns. But what if those returns, the actual ROI from the AI functions, don't show up as fast as people hope over the next, say, 18 months?
Then the funding dries up.
Potentially very quickly, yeah. That pipeline of new data center projects could cool off just as fast as it heated up. It's not just a slowdown risk. It's the risk of a rapid collapse in the only thing driving major construction volume right now.
Okay, that vulnerability makes things really tense. Extreme tightness now because of current demand, but this big cloud of worry about the future. Let's connect that directly to steel. Starting with rebar. That's the backbone for concrete buildings like data centers, right?
Exactly. And the rebar market, it perfectly mirrors this tension. The consistent story there is extremely tight supply and, well, sustained upward pressure on prices.
So what does tight supply actually mean for a contractor, like day-to-day trying to get a job done?
It means major headaches with lead times. Mills are running flat out, basically at capacity, but they're still struggling just to meet the delivery schedules they've already committed to.
So delays are common.
Very. And it pushes lead times way out. Producers right now have basically zero floor stock, nothing sitting around ready to go. If you want to place a new order, the earliest rolling schedules they can offer you are stretching deep into December.
Deep into December.
Yeah.
So order today, maybe get it end of Q4, possibly even Q1 next year, no matter the price.
That's pretty much the reality, yes. And this domestic tightness is so bad it's pulling up import prices too. Even though domestic mills haven't announced massive hikes recently, the spot prices for imported rebar, say in Houston or the East Coast, they've jumped up to match what importers are asking for future deliveries.
Because importers know buyers are kind of stuck.
They know they have leverage right now, yeah.
And no quick fix on the supply side is coming. Those new mills we heard about.
Still some time away before their output really makes a dent. So yeah, the expectation is these supply constraints might actually get worse before they get better. The tightness is very real right now.
Okay, let's switch gears to the other product you mentioned, wire rod. Used more for manufactured goods, right? Mesh, welding wire, stuff like that.
That's right. Often an input for manufacturers rather than direct structural use like rebar.
So is that market seeing the same kind of extreme pressure as rebar?
Well, this is where it gets interesting again. It's actually quite different. The wire rod market is much more balanced at the moment.
Balanced.
Supply and demand are pretty much matching up. A big reason is that domestic production has stabilized. The report specifically mentioned Liberty Steel's mill in Illinois getting back to near normal output. That helped calm things down domestically.
Okay, so if domestic supply is stable, you'd think imports would be more competitive, maybe push prices down.
Logically, yeah. But here's the twist. Regulatory issues are throwing a wrench in the works. Import offers have actually slowed way down.
Slowed down. What if the market is balanced?
It's not about lack of demand here. It's about the hassle and cost for importers. They're facing high tariffs, there's talk of potential new port charges, and the ongoing anti-dumping cases on rebar, especially against places like Egypt, Algeria, Vietnam. That's causing disruption and uncertainty that spills over.
So the regulatory friction is acting like a barrier, limiting import supply, even if the pure market economics might favor it.
Precisely. It just makes it riskier and more expensive for international sellers to bring material in right now.
So even though it's balanced now?
People are cautious. Customer interest in booking shipments for Q1 is still pretty decent, because everyone knows this balance is fragile. If there's any disruption to domestic production, a mill outage, whatever you could see, shortages pop up really quickly, just like in rebar.
Okay, let's try and tie this all together for you, the listener. We've covered quite a bit, and it feels like there are conflicting signals everywhere.
There really are. You've got this unexpected recovery, or at least stabilization, in office demand, lower vacancy, more leasing, but at the same time, a total collapse in office construction.
Right. And then, meanwhile, the overall non-residential construction volume that is happening is almost entirely propped up by this massive wave of data center spending.
Which in turn is causing severe tightness and those long lead times, particularly for rebar.
So the key takeaway seems to be that the construction market is running hot, but really on just one cylinder, this data center engine. And there are signs of stress, elsewhere in the system, like those falling backlogs for other types of work and the regulatory issues impacting imports.
That sums up the critical balance, yeah. Or maybe imbalance. You've got super tight steel supply for things like rebar, stretching into December, driven hard by this data center boom.
A boom that, as you said, many worry could be a speculative bubble.
Exactly. So if those broader construction backlogs, the ones falling by a third, are the real predictor of how healthy things will be in 2026, well, you have to consider the risk.
And that leads to the final thought, the provocative question maybe. How quickly could those super tight steel schedules, those long lead times we talked about, just evaporate? If that huge flow of money into AI infrastructure slows down even a little.
Yeah. Given how much we seem to be relying on that one single sector, the timing of any potential slowdown becomes incredibly important for market stability heading into next year.
Definitely something anyone involved in buying or selling materials needs to be thinking about.
Absolutely. Modeling that risk is crucial right now.
Okay, that's all the time we have for this deep dive. Thanks for joining us.
Thank you for listening. Explore more at www.staalx.com.